Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 135. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, we've got a packed weekly this week because we have 2 weeks worth of macro data, and we will be concentrating on the macro data this week. Next week, we'll return to a more normal program. Okay, news. Well, during the last 2 weeks, obviously the big news was that Hamas attacked Israel, and that has led to a spike in oil prices. But the markets are currently not pricing in a wider regional conflict. The Chinese property developer Country Garden has missed a bond payment, and it looks increasingly likely that they will default. Now, Country Garden is China's biggest property developer, so that could have wider implications. It has $200 billion worth of debt. The bond sell-off continues, I'm afraid, after strong US economic data, which we will go through. And the odds of a further Fed rate hike have risen. And the US House of Representatives remains without a speaker. Reminder, the current deal to keep departments funded runs out on the 17th of November. So this is the oil price, which has spiked after Hamas attacked Israel. And the market is now pricing in a 60% chance that the Fed hikes again after some strong US economic data, which we will go through. And on that note, onto the economic data. Richard, the UK.
Thank you, Keith. So UK retail sales month on month down, and there's an article in the FT this morning talking about consumer confidence having dropped substantially. I think the UK is probably definitively in slowdown mode now.
Yeah, what I thought was interesting was that non-food store sales fell by 1.9% in September. That is a big drop in 1 month.
And UK retail sales year on year, clearly 1 month won't have much impact on the year on year figure, but it's noticeable that it's still negative. And UK CPI month on month, we're still around about 6.5% inflation in the UK, which is not good, and it's not under control, and it's higher than in Europe and higher than in the US.
Now, next month, Richard, I expect UK inflation to drop sharply because October 2022, month-on-month number was 2%, and that drops out of the window.
Yep.
So, assuming that October is, let's say, 0.3%, then UK CPI should drop to around 5%. That should be a big drop.
Fingers crossed. This is the UK CPI year on year, which is falling sharply from its peak, but has a long way to go, and as I said, much worse than Europe and the US. And UK core CPI month on month, 0.5% month on month, actually came in on expectation.
Yeah, not great though. 0.5%, not great. Although the August number of 0.1 was exceptional. So perhaps it's just, if you average the two, not too bad.
Yeah, possibly so. And there's core CPI, which is like, stabilized at 6, hasn't it?
Yeah, not great.
And our RPI year on year is around about 9%. So we have a big inflation problem still. And UK services inflation is high. So we've got falling goods and offset by very high transport, which is obviously oil price, restaurants and hotels. So we've got some significant inflation in areas and some significant reduction in areas. It's good that food inflation's gone negative.
Yeah. But I've highlighted in red basically services. The inflation is still persistent.
Yeah. And UK average weekly earnings is around about 8%. And that clearly is going to make reducing inflation difficult until that drops. Average weekly earnings ex bonuses. I mean, the only reason for having, I guess the only reason for thinking this data is significant is that bonuses are discretionary, whereas rates of pay are, they can be discretionary, but if you change them, it causes a great deal of upheaval in the business. Anyway, rate of inflation of pay, whether you like it as the ex bonuses or with bonuses, is too high to be consistent with a low rate of inflation.
Yeah, but here you see that it's 4.2%. Actually, the latest data.
Yeah,
now,
but
month on month, that is.
Yeah.
Which obviously is subject to revision. But it would seem, if you look at the recent trend, that wage growth is coming down. And that's exactly what you'd expect given the fall in inflation.
You might switch that the other way around, Keith, and you might say you would expect a fall in inflation if wage growth is diminishing.
Well, the thing is that wages tend to follow inflation, not the other way around. So people demand higher wages to compensate them for historic inflation. And so the one-off surge in inflation tends to lead to.
So I don't agree with that analysis on the way down, because I think what we're finding is that businesses are struggling to maintain their margins, I suspect, and that is constraining wage growth. It's probably a combination of all factors. I don't think it's a simplistic relationship. So UK vacancies, job vacancies, continuing to fall. So the labour market is tight, remaining tight.
Yeah, I mean, job vacancies are still much higher than pre-pandemic.
So okay, so UK HMRC payrolls, that's the number of people on the PAYE system, and obviously they have real-time reporting, so they get this information every month. And basically, the number of people on PAYE has been pretty much unchanged for the last 3 months.
Well, it's falling, and that is a definite change in the trend.
Yeah, I disagree. Sorry, I do disagree. We're talking about 11,000.
Yeah,
in a working population of millions and millions.
That's true. Yeah, I'm
not sure that it's particularly useful data. UK BLC retail sales monitor is still stable around about 3%, isn't it? And it's a little bit above consensus expectation, which is slightly contradictory with what we've seen.
Yeah,
we're seeing now with retail sales. So we've got this classic issue of contradictory data.
Yeah.
UK RICS house price balance is showing that more than 50% of surveyors are reporting house price falls. I mean, I suspect house prices are pretty much falling everywhere in the UK at the moment. And UK GDP, 0.2% month on month in August. About a big drop in July. So, and year on year GDP, we have virtually no growth. Industrial production month on month falling, and quite a lot bigger than the expectation fall. And industrial production year on year is actually sort of rising steadily, but it's sort of around about that sort of mean level it's been at for the last 10 years if you ignore COVID.
Yeah, actually, I'm quite impressed that it's recovered. I mean, so presumably the growth is from a low base over the last couple of years.
Yeah, that's a good point, actually. Yeah. Because it is growth, isn't it, as opposed to an absolute figure. UK manufacturing production month on month. So we've had 2 bad months, actually, July and August, although they are holiday months, so maybe that's the reason. And year on year, it's above 0, which is good. and it's sort of a roundabout trend if you go back pre-COVID. So UK consumer confidence data from today is -30. I think people were hoping that that line upwards was going to continue to extend up towards zero, but it hasn't. It's gone back down, and consumers are pulling in their horns. UK construction output, actually, I would say, is remarkably stable.
Hmm.
Mind you, you have to look at the number of cranes in London to wonder, where it's all going to end up.
Yeah, but the month-on-month numbers, they've now had 2 negative months in a row. So, as you'd expect, new work is declining.
Yeah. And the UK brick production down 30% year on year in August.
I think this confirms the fact that house building is in serious decline.
So, I mean, it's still a mixed picture, but I think we're starting to see some data which suggests that the rising interest rates that we've had for the last year and a half now are starting to bite quite hard, I think. And I think we're going to see this continuation of this bad data over the next few months.
Yeah. Okay, thank you, Richard. On to the EU. And EU industrial production actually bounced back quite well in August, up 0.6%, beating expectations, although the July number was revised downwards. And year on year, the numbers are not good. Industrial production down 5.1% in the year to August, missing expectations. The economic sentiment index, though, bounced in October to plus 2.3, which I found very surprising. So economists are increasingly positive about the EU economy. Construction output fell in August, massively missing expectations. And the Citigroup Economic Surprise Index for Europe continues to be negative. So, in summary, surprisingly, economists are increasingly confident about the EU economy, but all the data suggests that the EU economy is slowing and construction output's falling. So, we continue to expect the EU economy to slow as the effect of higher interest rates takes effect.
Yeah, it's hard to see how they can escape that bullet, Keith.
Yeah. On to the US, Richard.
Thank you, Keith. So US non-farm payrolls looking very healthy there. So the non-farm payrolls report for September showed the US is still enjoying economic growth, nice economic growth. So you can see all the selected industries which are have continued growth. The only actually negative one there is information.
Yeah, IT.
Yeah, and then we've got the construction sector has continued to add jobs.
Yeah,
even though the slowing of construction is fundamental to the slowdown of the US economy.
Yeah, absolutely. You'd expect higher interest rates to lead through to lower construction spending quite quickly, and that just hasn't happened.
But as we've talked about previously, Keith, there's a lot of government money is going into onshoring.
Yeah.
And building up manufacturing plants, which is definitely skewing the figures. We just don't know to what extent. And there was a streak, quite a big streak, of negative non-farm payroll revisions. And now that they have become positive again. Many of the new jobs were in restaurants. Yeah, part-time, but that suggests the service economy, all the discretionary expenditure, entertainment should be doing well. Again, not what you expect if there's a recession. So it lost full-time jobs for the third month in a row.
The headline numbers look much stronger than the actual detail, because although the non-farm payrolls beat, actually the US continued to lose full-time employees, and then it gained 123,000 part-time employees. And then the number of people working 2 or 3 jobs rose by 151,000. That is not a good sign for the US economy.
No.
And the number of gig workers rose by 222,000. So the detail showed actually a lot of those jobs were quite low quality jobs, and permanent jobs continued to fall.
I mean, if the US is going into recession, it's certainly taking a long time to do it.
Yes, absolutely.
So if you ignore all the seasonal adjustments, the private sector lost 400,000 jobs in September, but 984,000 jobs were created in government. Apparently, mostly teachers. So government expenditure and the US debt is vast and growing at a vast rate. Is distorting the economy, I think. The number of people unemployed for more than 15 weeks is continuing to rise, but actually it's only just a little tick up, and it's quite a, the graph goes up and down.
Yeah. The one thing you'd say, though, is when it does rise, it tends to trend.
Yes, that is true. Yeah.
But yeah, point taken.
And temporary help services employment continued to decline. So people aren't employing so many maids and butlers and gardeners, presumably. So the jobs market is remaining tight. And the NFIB survey showed that 43% of all owners reported job openings they could not fill. And 37% have openings for skilled workers, 18% have openings for unskilled workers. So there's still significant tightness in the jobs market, isn't there, Keith?
Yeah, absolutely. Reminder, NFIB is US small businesses.
And the US unemployment rate stubbornly at around about 3.5%-ish. US permanent job losses do tend to rise ahead of recessions. And we have got some permanent job losses starting to appear in the US. And the US employment participation rate is still rising. Bear in mind that the scale on the right-hand side of this chart is very small or large. Is it large? Large, isn't it? So the whole thing covers 3.5 percentage points. And US prime age worker participation is now back above its pre-pandemic levels, back to where it was in the year 2000.
So that suggests that older workers have not returned to the workforce, but prime age is a
you and I, Keith.
Yeah.
US weekly hours worked 34.4. Again, there's a very large scale on the right-hand side. US average weekly earnings month on month only going up by 0.2%, which would equate to maybe 3% annualized compound.
Yeah.
Much lower than in the UK. And look at that, 4% average weekly earnings year on year, 4.2%.
Yep. Inflation seems to be coming right down in the US.
Yeah. And the wage growth, the Atlanta Fed wage growth tracker down to 5.2%. So that's steadily falling. Bank of America deposit data, which presumably looks at wage checks being banked, is suggesting that wage growth is slowing, particularly for highest paid workers, those the yellow ones. And the business optimum index is down at 90. I mean, I guess probably 100. It does look as if it's roughly the mean, which presumably it ought to be. And the outlook component of the survey deteriorated rapidly. Other people's outlook is not great. But if you look at that outlook graph, the outlook's been on a relentless decline, and the economy hasn't.
Yeah, absolutely.
US retail sales month on month, very healthy.
Yeah, now I find this absolutely amazing. We've talked a lot on this podcast about how the US consumer is coming under increasing pressure. And last week, we showed credit card data, which seemed to show that the US consumers were cutting back hard on their credit card spending. And we know that in September, demands to pay student loans were sent out, although they don't actually have to make the payments until this month. So all of that would suggest that the US consumer should be weakening. And this was an absolutely amazing beat and shows that the US economy just is incredibly resilient.
Yeah, it is. And here are the US retail sales year on year, which, if you go back to 2014 to 2020, that's where they are, steady growth. And data for the last 2 months revised upwards for retail sales, so as well as the jobs report. US CPI month on month, 0.4%, so worse than expectations, as was August. And so year on year, again, you're seeing that uptick. Now, whether that's just a little statistical fluke and it'll carry on down, we don't know. Although if oil prices continue to rise, that's an impact. And there we have the CPI, US CPI. It's all in shelter, the dark color, whatever that dark color is.
Yeah.
Shelter.
Exactly, Richard. Because people were talking about, US CPI failing to come down. But actually, that shelter is a lagging indicator. And
because of the way you measure
it. That should rents, we know, are actually negative in the US.
Yeah.
So that will come down over the coming months. And really, I don't think the US has got an inflation problem.
Well, I suspect that energy may replace it, but to what extent?
Yeah.
We don't know. So there's US core CPI month on month, 0.3%. And year on year, it's at 4%. And the trend is down, although it didn't move much in September. US export prices are still negative, but not as negative as they were. And US import prices likewise heading back towards zero, really. Again, the import price, that negative impulse, if that disappears, then obviously that will drop out of one of the factors no longer influencing the inflation rate. And the US Michigan Consumer Sentiment Index is at 60 something, and it's not great, but it's not a disaster either.
Well, actually, I'd say that's quite a poor number. It's at its lows.
Yeah.
Of the post GFC.
And Greek, and actually, has that trend, that little trend that started from 50 upwards, has that been broken or not? But if you look at retail sales,
I know, absolutely. Because last month in September, still not a great number. Retail sales were fine.
Yeah, everybody's just feeling gloomy. And the current conditions actually look remarkably similar. And the Michigan Consumer Expectations is showing the same thing. And the one-year inflation expectation, is it a noisy downtrend or has it reversed? At the moment, it's a noisy downtrend, actually.
Yeah, I think this is very correlated with oil prices, basically.
Yeah. And 5-year inflation expectations, basically they're around about 2.8 to 3% and have been for the last 2 years. In US industrial production month on month, an increase there, 0.3%.
Yeah, although August was revised down to 0.
Yes. And year on year, doesn't appear to be any growth, basically, in US industrial production. US manufacturing production month on month, reasonable amount of growth, 0.4%, higher than expected. And year on year, though, it's just slightly negative. And this is really noisy, isn't it? It's been really noisy for the last year and a half or so. It's hard to know what it's really telling us, but it's quite a noisy chart, but it's difficult to I think it's difficult to interpret, particularly other than to say that it's sort of not that far from zero. And we can't really tell from this where it's going.
But it's returned to being negative.
Yeah, it has. And whether that's just a bit of noise in the series or whether it's a trend reforming, who knows? It's really difficult to tell. National Association housing market index is showing, I would say, definitive signs of weakness there. Looks like it's going to go back down towards 30 to me.
Yeah.
Which is what you'd expect it to do. And so here we have the Conference Board Leading Economic Index, which is the blue line is actually really pretty negative, pretty horrible.
Yeah. But the grey line is GDP.
Yeah.
And this is the problem in one chart, Richard.
Yeah.
So the leading index has been negative for quite a long time now.
Yeah.
But GDP has held up remarkably well.
You have to go back to 2008, don't you, to see that sort of size bifurcation. But even then, GDP was falling.
Yeah. Whereas GDP has actually recovered.
Yeah.
It's odd. Yeah. It's amazing. The US has survived a rapid rise in interest rates much better than I, in particular, expected it to.
Yeah. Okay, so the US Red Book, retail sales looking healthy.
Yes.
And the US savings rate. So if you ignored pre-pandemic, the US saving rate was somewhere between 5 and 8%. If you go pre-pandemic. The US savings rate now is somewhere between 3 and 5%, I would say. And currently it's 4. So it's definitely changed. And the 30-year mortgage rate is continuing to climb inexorably towards 8%. And the mortgage market index is reflecting that fact by inexorably heading towards zero.
Yeah.
Maybe not zero, but it's down and going down.
Unsurprisingly, very few people are taking out a mortgage.
If you take that red line and you move it up to underneath where the low point at 2000, you can see that 2015 and 2018, 2019, the low points roughly hit that red line. And now the index has fallen hard through that previous low. So US housing starts seem to have finally broken.
Well, Richard, I disagree. I mean, that is a decent number.
I think it's broken, Keith. I think we'll see that this trend now continues down.
Really? Okay.
But I'll put my money where I won't put my money where my mouth is. But my sense is that is now starting to look like it's broken. Housing starts month on month. Possibly not that useful a chart because it's very, very noisy.
Yeah.
Building permits is actually following a little bit of an uptrend because a building permit is not the same as a building start. And then we have month-on-month building permits. Housing starts, single-family units.
Well, I'm just amazed by this because we know that mortgages have collapsed. Nobody's taking out a mortgage.
But these are starts, Keith.
Yeah. So, but you've got to sell them to someone.
Yeah, but the psyche of the two isn't necessarily the same. Optimism by the executives,
right,
and people actually saying, "I'm not buying a house, or I can't afford to buy a house, or I can't pay that much at this level of rate." I don't know that you can differentiate housing starts yet from where it's going. I may be wrong, It shows that the building sector is optimistic.
Yeah.
And this does the same.
Well, this is apartment blocks, and this does show a substantial drop. So you've seen a 1/3 drop in.
Yeah, but it's only gone back down to the pre-COVID base.
Yeah. Yeah, but GDP is a function of change.
Yes.
So that is the construction sector slowing.
Yeah. Existing home sales, I think they're just going to break down towards 3,000.
Yeah. And this does actually matter because although these are houses that already exist so that, it doesn't affect construction, when people move house, they generally, buy new furnishings, they have to remodel the house, etc., etc.
Yeah.
And the fact that nobody's moving should have an effect on consumer spending, particularly on durable goods and home furnishings. But we've seen that, consumer spending is very good.
Yeah. Existing homes month on month. Okay, that's what you'd expect because of the shape of that year-on-year chart. So US initial jobless claims is back down to where it was nearly a year ago now, and looking to be fairly stable around that level, actually. So strong.
Yeah, no sign at all of an increase in layoffs.
People aren't being laid off, yeah. Unlike the continuing jobless claims, which is actually starting to move up and suggest that once people have been laid off, they're finding it harder to get a job.
Yeah.
And the economic surprise index, as ever, surprises on the upside.
Yeah, still, the US economy continues to be stronger than expected.
Oh, and the credit impulse is falling fast, hard. So, I mean, again, a bit of a mixed message, but certainly the economy, as Keith just said, is proven to be very resilient. So non-farm payrolls beating expectations, but some indicators that the job market is weakening. Inflation missed expectations, was higher, but we know we've got this lagging shelter effect. And the consumer remains strong.
Yeah.
So
the US economy has been absolutely astonishing. You would expect the rise in interest rates from basically 0.25% to 5.25% to have really slowed the economy. And it just hasn't. It's been amazingly resilient. And on to China. So Chinese balance of trade continues to be hugely positive. And all this talk about deglobalization, well, you just don't see any evidence of it in the figures, frankly. Exports, however, fell 6.2% over the past year, though that was better than expected. And imports also fell. That doesn't portray a Chinese economy that's doing terribly well. Loan growth continues to decline, and that is a steady downwards trend. Now, GDP in Q3 beat expectations by quite a margin at 4.9%. Do we believe it? We ask ourselves. Industrial production, decent. Fixed asset investment is continuing to decline.
One of your assassins.
The unemployment rate fell to 5%. Now we know that the youth unemployment rate has been rising rapidly, and the Chinese have stopped reporting the numbers. So I am personally quite suspicious of this. House price change, essentially zero.
I'm quite suspicious of that.
Yeah, I agree with you. The credit impulse is negative and falling, and real estate investment is falling. Now, we've talked previously about how the Chinese are investing in manufacturing and industrial capacity to offset this fall in real estate investment. Well, it all comes down to whether you believe the figures or not, frankly. The one data we know, the hard data, is both imports and exports are falling.
And we know we've got a property crash.
Yeah. Okay, and on to errors and corrections. And thank you to Mr. C. Peckham for pointing this out. 2 weeks ago, I got backwardation wrong. So this is the oil futures chart. Backwardation is when futures prices are lower than current prices, and the market is therefore expecting more supply in the future and is encouraging traders to take oil out of storage to supply the current market. So the current market is tight, and therefore backwardation means traders are encouraged to sell oil now. Contango is when futures prices are higher than current prices. So the market is expecting a tighter market in the future, and the futures curve is encouraging traders to put oil into storage in anticipation of higher prices later. And onto one chart. Now, the reason I think that we've had a huge sell-off in government bonds is that the US economy has just been amazingly resilient. So this is the Atlanta Fed's GDP nowcast over the course of the last year. And the Fed has raised interest rates very quickly to 5.25%. And you would have expected that to lead through to a declining US economy, slowing US economy. Instead, it's growing at 5%. So the bond market is essentially pricing in interest rates staying at these levels forever, because the US economy seems to be coping very well with interest rates of 5.25%. And on to inflation watch, Richard.
So new data from the UK, which we've discussed, 6.1 for core, 6.7 for CPI. The US, 4.1 for core, which is unchanged, 3.7 for CPI. And the EU, 4.5 for core, 4.3 for CPI, both down. And UK RPI, 8.9%, down, but still frighteningly high. And this is the US trueflation, which we've been showing you every most weeks for quite a while now. And this is suggesting actually that inflation hit around about 2% in June, maybe a little bit more than that, but it's basically, and hasn't changed very much since then.
Well, it's again suggests the US does not have an inflation problem.
So I would expect trueflation and US inflation, the sort of conventional inflation measures to converge.
Yeah.
And then not.
Well, it's the CPI shelter, isn't it?
That's true. Yeah. So the UN food price index is continuing to fall. Yeah. Is it leveling off a bit? Difficult to say. A lot of uncertainty in the world at the moment, which is not good for food prices. And the US added 5 million foreign workers, which should reduce tightness in the labour market, one would have thought, which is a vast number of foreign workers, isn't it?
It is. That's an amazing
Mostly,
number.
presumably, they've come across the southern US border.
Well, yeah. No, so a couple of weeks ago, we talked about how Biden had given 500,000 Venezuelans temporary work permits.
Yeah.
And I was speaking to our US fund manager friend this week, and he was saying that he'd been to the airport and there's an immigration official there handing out the kind of the forms to the long line of Venezuelans who were then taking flights to all around the country. And these people, the 500,000 Venezuelans, are going to get to work quite quickly, it seems. So all of that should bring down wage inflation and solve the labour market difficulties.
Yeah, you would think so. It's not having an effect yet, is it? Which is interesting.
No. Well, it's take a little while.
Yeah. So UK trueflation is also falling quite fast, now down at 6%.
Yeah. This is quite, I don't know how much to believe this. It's very lumpy.
Yeah.
But still, good. The trend is a good one.
And 78% of EU inflation components are decelerating, which is a lot.
Yeah.
So EU inflation should continue to fall quite quickly. So everywhere inflation is basically falling and is, well, yes, expected to continue to fall. I'm not entirely convinced, actually. Obviously, the Middle East is another issue that has only just arisen.
And on to recession watch. Now, the yield curve is disinverting, and that tends to happen before a recession. So, is a recession finally approaching? The probability of a US recession, as predicted by bond yields, remains high at about 56%. Corporate bond yields are rising. That increases corporate borrowing costs and adds up to tighter financial conditions. Apartment prices in the US are now falling, and that should be good for inflation, but also should discourage apartment building. And we have seen that 30% drop in new apartment block starts. And savings in the US, and this is from the gross national income data, is actually negative. So that suggests that the US is consuming savings in order to maintain consumption. Now, how long can that last? And CEOs in the US are more pessimistic about the prospects for the US economy than is Wall Street. CEOs think there's an 80% chance of a recession. Wall Street thinks there's zero.
We shall see.
Yeah. Now, this is the Joshi rule, and it predicts a recession when it goes above 0.2, and it's picked up, but is not yet a 0.2, and it measures the rise in permanent job losses. And we've seen permanent jobs have been falling, and US consumers are increasingly worried about whether they can make minimum debt repayments, although it's not particularly elevated yet. But the bottom line is that the full effects of tightening have yet to be felt. So around a third of the impact of the Fed rate hikes on GDP has yet to be felt, and about 60% of the effect on the jobs market. And Bank of America data shows that the number of people receiving unemployment benefit has returned to its January 2019 level and is particularly elevated amongst the higher earners. So it suggests the jobs market is tighter at the lower end of the spectrum than at the top end of the spectrum. And bankruptcies have been rising, and mortgage servicing costs have gone through the roof. So this is the median house price times the 30-year mortgage rate. And it is at levels last seen in the 1980s. And so this is from the recruitment agency's Page Group. And you'll see at the bottom here that the number of permanent hires globally fell 15% over the course of the last year, while the number of temporary jobs rose. So it seems to be a global phenomenon that companies are laying off permanent staff or not recruiting permanent staff, but they are recruiting temporary staff. So in summary, the lagged effect of the very rapid rise in US interest rates should slow the US economy in the coming months. But we've been saying that for a very, very long time now, and it's doing just fine. On that point, how do rising interest rates slow the economy? Well, first of all, they increase borrowing costs as people with existing borrowings have to refinance them at higher rates, increasing their interest expenses and reducing their disposable income. 2, it increases the attractiveness of saving. 3, it increases the cost of borrowings for large investments and purchases, such as cars or housing. 4, there's a negative wealth effect. So rising interest rates should mean falling asset prices, which means that consumers feel less wealthy and cut back on expenditure. 5, bank lending declines as their cost of funding rises, leading to margin compression, and they're less incentivized to lend money. And 6, there's the possibility of a financial crisis, as higher rates mean mark-to-market losses on financial assets, potentially causing failures of highly leveraged entities. Now, if we go through these, increased borrowing costs in the US, because US consumers have locked in 30-year mortgages at very low interest rates, actually it hasn't really affected them as much as it has in the UK and EU, where you have much shorter term mortgages. It is affecting US consumers through increased credit card interest rates, but that's a much smaller effect. The main effect should be on the mortgages. And so the rise in interest rates is not affecting their mortgage rate. So still leaving them with a lot of disposable income. Increases the attractiveness of saving? Well, no, actually, their savings rate has fallen. Increase the cost of borrowing for large investments and purchases? Yes. So we're seeing a drop in mortgages, but car purchases have held up remarkably well in the US. Negative wealth effect? Well, actually, the US stock market has been remarkably resilient, and so there hasn't been a negative wealth effect. And there has been a decline in bank lending, but so far that doesn't seem to have affected the economy. And finally, as yet, no financial crisis, although various entities with exposures to bonds in particular must be nursing enormous losses. So, in summary, the US economy is not behaving as you would expect given the rapid rise in interest rates. Richard, any thoughts?
No, you're quite right, Keith. You've sort of nailed it, really. And that's what's caught us out in terms of our predictions.
Yeah. And on to soft landing watch, Richard.
So the Fed estimates, apparently, that the impact of its rate hikes on financial conditions is beginning to fade. In other words, the system is adapting to the higher interest rates, which may or may not be true.
Yeah.
But if it is true and they continue to feel inflation is too high, it means they'll need to increase interest rates more. Whether that, anyway, it'll be interesting. Given what Keith has just gone through in terms of why our predictions have been wrong, one wonders whether this is actually correct. So inventory growth has stopped rising. See, inventory growth grew incredibly fast post-COVID. But now it is back to sort of fairly standard 4.5% year-on-year inventory growth rate, which should be roughly in line with GDP, really, shouldn't it? Heavy truck sales in the US are doing very well, which suggests the transport sector is doing well.
Well, actually, this is also the construction sector. So I think heavy truck sales also involve things like diggers.
And US rail container volume has risen sharply over the past month. Lots of goods being moved around, and therefore an active economy. Manheim Used Vehicle Value Index has fallen back a little bit, but it's not falling sharply.
No, still actually really elevated.
Yeah. guessing. And then consumer credit quality is remaining good with a very low default rate. And corporate default rates don't appear to be going up anymore and haven't actually gone up particularly far either.
Yeah.
And we have initial unemployment claims not rising as you would expect if we were at the start of a recession. We're very much not at the start of a recession yet.
Yeah.
We keep saying yet, we've been saying it for months. And JP Morgan is estimating the US economy will continue to grow at around 1.4%.
Yeah.
So they are definitely on the no landing front. And Goldman Sachs think there's a less than 20% chance of a recession in the US in the coming year. So they're pretty much on the no landing front as well.
Yeah.
And probability of recession versus junk bond credit spreads. So probability of a recession is in red. Junk bond credit spreads in white. And which lags, the white line lags.
Yeah, it does.
But it hasn't done anything yet. We shall have to see. So yeah, no landing.
Yeah. I mean, the bottom line is that monetary policy does not seem to be working very well. I mean, it is the US labor market is slowing, but the US economy, I mean, Atlanta Fed's GDP now is showing that it's growing at 5%.
Yeah.
It's amazing.
Yeah, it is, isn't it? It is indeed. So, I mean, just have to watch this space because it is proving totally resilient to the interest rate increases.
And quickly onto ethical investing. I think you'll like this, Richard. So, ESG funds, and this is the iShares ESG fund. In its performance is in blue. The S&P 500 is in yellow. You'll see that essentially it's pretty much identical. So ESG funds don't tend to outperform the index, basically. And they also historically have tended to have a big tech weighting. So what are the attractions of ESG funds? Well, the sole advantage really is to align your investment strategy with your ethics. I mean, there's no evidence that ESG funds have superior performance characteristics. And in particular, the investments such as solar energy or wind farms, those tend to be quite low return.
I mean, you have to ask the question, why would they, don't you? Because, they're not doing anything. In a sense, they're probably, well, then first of all, they're not really representative because it misses out a whole sector of the market. And then secondly, if they're really ESG, the underlying companies, if they're truly ESG, their cost base is likely to be higher.
Yes, very good point.
So I don't understand why they haven't underperformed. Well, I do, because they're not really ESG.
Well, they're just stick it all in big tech, frankly.
Depend.
Now, the problem with ESG funds is that it's very difficult to define what an ESG investment is. I mean, how do you define what is,
Well, I think copper miners must be an ESG investment because we need copper to electrify the world.
Yeah. Well, I agree with that.
And actually, if we're going to invade Ecuador, then munitions to facilitate copper mining, then munitions would be ESG, wouldn't they?
Well, I think you've defined some of the problems with ESG, Richard. But anyway, so ESG doesn't outperform. How about doing the opposite? So John Authors at Bloomberg has had a look at basically investing in dictatorships, and they tend to do quite well. So this is in dark blue, the performance of the Spanish stock market under General Franco.
Well, Keith, I think we need to reopen consideration of investing in the Russian stock market.
Well, yes. And
Really?
actually, if you look at data from the World Bank. So this is equity total returns based on the Human Freedom Index, which is low crime and political stability. Then investing in the worst countries gets you by far the best return by a factor of 2 at least. And investing in autocracies, again,
what's not to like?
What's not to like? So Kim Jong-un would welcome your money.
Should we do a Portfolio Matters visit to North Korea, do you think? Exploratory visit to open up a dialogue.
Yeah, I wouldn't go that far, Richard. You remember last year there was that American guy who
a basketball player.
Well, no, actually, before that, there was an American tourist who took a poster off a wall as a souvenir and was arrested, imprisoned, and died in custody.
Oh no!
So yeah, I wouldn't go there in person.
No, I didn't. I'd forgotten that. You're quite right.
And on to other charts, Richard.
Thank you, Keith. Very few cities in China, we had this before, didn't we, are reporting price rises.
Well, the thing is, the month-on-month numbers we reported earlier was showing that Chinese property prices only fell 0.1%. It doesn't seem very compatible with this chart, frankly.
No, I would agree. China's been boosting industrial investment to try and offset decline in real estate investment. And well, the thing about industrial investment is, as Keith has rightly pointed out here, you have to have someone who consumes the product of your industrial investment.
Yeah,
not entirely clear who that will be. Perhaps another wave of deflation is heading towards us from China. Chinese EV production has gone ballistic, but I don't know how much of this is consumed in China, how much they export, Keith.
Well, your point earlier, Richard, about who's going to consume all this, they're producing too many electric vehicles, so they're now exporting them. Okay, thank you, Richard. On to good news. And the Dogger Bank wind farm is live as of this week. The first of a planned 277 turbines began spinning 70 nautical miles off the coast of Yorkshire. And each turn of the blades on one of these turbines produces enough energy to power the average home for 2 days. That's just absolutely amazing.
Yes, isn't it?
And this, the Dogbank wind farm will eventually produce 3.6 gigawatts, enough for 6 million homes.
I don't wish to pour cold water on this, Keith, and I may be wrong, but there have been some issues, haven't there, with these giant wind turbines? They haven't been well tested, and we don't actually know what their lifespan is.
That's true. And when the wind doesn't blow, what do?
That's just still asking awkward questions.
Yeah, but this is the good news section, Richard.
Yeah,
exactly.
The wind doesn't blow. It's good news, Keith, because it means we've got nice weather.
And on to equities, Richard.
Thank you, Keith. Shall we carry on with the good news? So the good news is there was no weekly change in the FTSE All World Equity Index.
All this data is the last 2 weeks, actually.
Right, yeah. Thank you. And the FTSE All Share Index was very slightly up for the last 2 weeks. And the Euro stock's very slightly down. Stock market's actually not having done very much recently.
Yeah.
Bobbing around a bit. S&P 500, a bit of a down channel there. I would hazard a guess. As is the Nasdaq. But I don't think it's of any significance unless it falls off a cliff. The Russell 2000, however, is actually not looking very healthy at all.
Yeah.
And the Hang Seng doesn't look that good.
Yeah. Suggests the Chinese economy is not doing very well.
Yeah. Indeed. So there's the topics. And Japan is actually doing jolly well, considering the amount of government debt that the Japanese central bank has bought. And Bitcoin has had a little bit of a revival of late. Keith is rubbing his hands with glee as a major Bitcoin. You're a Bitcoin whale, I think, aren't you, Keith?
Bitcoin mystifies me. I mean, apart from unless you're a criminal, why would you need it?
I'm afraid I can't tell you that.
Hmm.
So the pound is just really not doing very well. It's down against the US dollar significantly. It's also down against the euro, which may, the US, there we are. There's the euro US dollar, which is not down quite so much against the US dollar. And have we got euro pound, Keith?
No, we haven't.
No. So the pound is heading down. It's about 1.14 against the euro this morning, I noticed. So, don't go to France for your holidays next year. In fact, don't go anywhere abroad for your holidays next year.
Yeah.
There's the dollar index, which has had a good run the last few months. Seems like it's all settled about 106. And the VIX, nearly there, Keith.
Well, the thing is, remember the rule was you sold it below 20 and you bought it above 30. And actually, it's been remarkably low for the last 6 months.
Yeah. The yield premium on US equities relative to bonds has disappeared.
Yeah.
So,
you can get a higher yield risk-free by holding US bonds.
Yeah. And NASDAQ earnings expectations grown strongly over the past 6 months, expectations. Because, of course, the mega cap weighting.
Yeah. This explains the outperformance of the NASDAQ, basically.
Yeah. And the S&P is not anticipating a recession in the next year.
Yeah. Okay, thank you, Richard. On to commodities and energy commodities. And the conflict in the Middle East has meant that the previous fall in oil prices has quickly reversed and they're up again today. So Brent is now at $93. WTI rose 8% over the past couple of weeks and is now at $89. And numbers specific to the oil market, over the last 2 weeks, we've had a reduction in US inventories of around 5.6 million barrels. So suggests the US oil market is undersupplied. But US oil production has been amazing. It's hit a new high for the year at 13.2 million barrels a day, up 1.2 million barrels a day year to date. And that's despite 120 fall in the rig count. Amazing.
Yeah.
This is Iranian oil production and exports at the top. Now, if there were sanctions on Iran, that would lead to potentially 2 million barrels a day going offline. And that would cause the oil price to go through the roof, frankly. But so far, touch wood, it seems that the conflict is not spreading. Now, we've talked about this before, but it does seem as though US gasoline demand is now structurally lower than it was pre-pandemic due to the increase in work from home, so lower commuting, and the rise of electric vehicles. So the dark blue line is US gasoline demand in 2023, and the dark blue line at the top here was 2019. And you see, actually, that's quite a big drop. That's around 1 million barrels a day. So like over 10%. Now, the conflict in the Middle East and the cold weather has meant that European gas prices have spiked up 45% over the last 2 weeks. But EU gas storage levels are very good, and the EU should be able to survive a hard winter even without any Russian gas. Although we are still importing Russian gas. So the red and the dark red are Russian LNG and Russian gas, which we are still taking some of it and helping fund their war effort. These are UK natural gas futures, again, up 45% over the past couple of weeks. US natural gas futures going down, actually, down 7.5% over the past couple of weeks. Coal drifting off, so not following oil up, which is surprising. Generally, they are quite correlated. Now, thank you to our Discord member, Uncool Tom, for sending us this. It shows that China increased its coal imports by 50% over the last year, and its liquid petroleum gas imports by 33%. Big numbers. Uranium fell 5%, but it's still. Is the bull market still intact, Richard?
Indeed, it is, Keith. It's hardly begun.
On to industrial metals, Richard.
In my view. Thank you. So there we have aluminium, cobalt.
Now, actually, there's a report in the FT saying that cobalt was structurally oversupplied.
Okay. Copper, not doing very well, actually.
Dr. Copper is looking quite sick, actually.
Yeah, indeed. Chromium.
Yeah, this is odd. Big leap.
Yeah. Iron ore, pretty stable. Lithium. Well, find it hard with lithium because obviously there's big demand for electric vehicles, but also a lot of supply coming on. So hard to know where that equilibrium is at any given point. Neodymium, presumably that's because of all these wind farms. Dogger Bank.
Yep.
Nickel. Tin.
Going nowhere.
Yeah. Ferrovanadium falling quite hard, which may suggest there's the price of iron ore hasn't changed.
Yeah.
Two are quite closely linked. Zinc and precious metals. So it's been a good week for gold. And actually, since in the last couple of weeks, it's risen from just above 1800 to I think it's about 1980 today. So sort of 10% increase in the last couple of weeks. Clearly, it's been impacted by the geopolitical instability that is Israel and Hamas and Palestine. Silver is sort of following gold, but lagging behind it. There's platinum, which basically isn't a monetary metal. It's an industrial precious metal. Rhodium, I noticed it had gone up. I've no idea why.
Yeah, well, some sign of life in the rhodium market.
Yeah. Palladium, no sign of death in the palladium market.
Yeah.
Maybe fewer catalytic converters. Maybe it's as simple as that.
Yeah. But then rhodium's picked up.
Yeah. Yes, that's true.
And on to rates. Thank you, Richard. Well, terrible in the bond market. The bond rout continues. The UK yield curve has shifted up just enormously over the past month and over the past 6 months, despite inflation coming down and the UK economy slowing. It's even worse in the US. So I think the UK, in fact, bond markets around the world are following the US. And the resilience of the US economy, it means that bond markets now essentially pricing in interest rates staying at 5.3% forever. Investors are expecting bond yields to fall over the coming year, and I very much expect that, but I've been totally wrong so far. The commitments of traders shows that somebody is very, very short US Treasury futures. And historically, crowded trades tend to unwind very quickly. But you need a catalyst for them to do so. Now, one of the theories about why US bonds were selling off and yields were rising is that there was a great deal of issuance and the market was suffering from indigestion and demanding higher yields. Well, frankly, that's just not true. The Treasury has been issuing Treasury bills, i.e. short-term bonds, and has hardly been selling any long-term bonds at all. And so all the Treasury bond auctions have been very well covered. The 30-year bond auction last week was covered by 2.6 times. So it is not indigestion. And bond issuance have actually been relatively low by historic standards. The Treasury is choosing to issue bills rather than bonds. US 10 years are now in the worst drawdown ever. And bonds look oversold, which yeah. Bonds have fallen so much that I think they need a catalyst to turn them around. I think bonds are falling until something breaks. You would expect, we talked about this earlier, but you'd expect that higher bond yields would mean that people would choose to invest in bonds rather than other financial assets. And that would tend to discourage investment. So you can now get 5.37% on a Treasury bond. So why would you invest in apartments at 4.2%? Surely the price of apartments has to fall until the yield on apartments is at least as good as the yield on bonds. Now, normally, the last Fed hike is good for bonds. So far, it certainly ain't been, although we don't know whether the last rate hike was the last one. Okay, so this is the UK 2-year, down from its peak, but still high. The 10-year, back to its peaks, not looking good. The 30-year at new highs, over 5%. That's an astonishing number. And over the course of the last year, that has shot up by 1% and has caused me huge losses. This is the US 10-year. Look at that. That is a shocking move in the last 3 months. So basically, since the Fed paused the hiking cycle, the US 10-year note has shot up by 1%. So one way of looking at that is that the bond market doesn't think that current US interest rates are high enough to bring inflation under control. This is German 10-year, Italian, Greek. Any change to your view, Richard?
No change. Keith, how about you?
No. Concluding comments. Well, the US economy just appears amazingly resilient, and the latest data on the retail sales shows that the US consumer remains strong. Now, again, we have this problem where all the leading indicators are suggesting that the economy should be slowing, but it's not. Can that continue? How have you done over the last couple of weeks, Richard?
Well, obviously, the price of precious metals going back up has been beneficial to me, Keith, although it's still significantly below where it was in May. And from my point of view, what I would like to see is price of gold breaking out to a new all-time high.
Yeah.
And I think until it does that, the jury has to be out. So it's been a relief from the pressure of the last few weeks, where it's the price dropped down to the low 1800s. So I would say that it's taken some of the stress off my portfolio. The uranium investments are doing reasonably well. They're very volatile. I mean, they'll go up and down 5 or 6% in a day. So you have to basically have faith in the long-term thesis and not worry about what the short-term price is doing. And how about you, Keith?
Well, it's been absolutely awful. Last couple of weeks, the bond rout continued, and I'm down 22% year to date, which is terrible. One of the worst drawdowns I've ever had. I basically bet big that the rise in interest rates would rapidly lead to a fall in economic activity and inflation coming under control. And in the UK, I think that's absolutely true. I think that the rising interest rates are leading to a fall in economic activity, and inflation is coming down.
Yeah.
But that hasn't worked out for my bond bet. But essentially, I think everything is following the US, and the US economy has been incredibly resilient. So, very stressful. Been completely wrong. I mean, basically, the bottom line is that the rise in interest rates from 0.25% to 5.25%, I thought would very rapidly cool the economy, and it just hasn't. Not in the US. And so, I'm looking very foolish. I've lost a lot of money. I am sticking with it because I just don't think that these yields are sustainable in the medium term. And I fully expect to exit this trade much better than I am now. But will I get it all back? Actually, I don't know. I don't know whether I'll get it all back. I'll certainly get a decent chunk back when central banks start having to cut interest rates. But that is a long way off. Now, it has taught me a lot. And when we come to do the my worst trade on this, there'll be a lot to talk about. But right now, it's not working. And we are in a continued bond sell-off, which, frankly, I expect to get worse before it gets better. So not much fun.
Yeah.
Okay, that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.